Bloomberg Tech is live from the heart of Silicon Valley with Ed Ludlow in San Francisco.
This is Bloomberg Tech. I'm Tim Stenovec in for Ed Ludlow. Coming up on the program, OpenAI is on track to generate annualized revenue of more than $40 billion. That's roughly doubling its run rate from the end of 2025. Plus, a new city bill backed by Mayor Zohran Mamdani calls for Amazon to directly employ their delivery workers. What will Amazon do if the bill passes? We discuss. And Meta's former chief AI scientist is joining a new venture firm to invest in AI startups. We'll be joined by the firm's leader, Sean Johnson. But let's start with today's big number, and that is $40 billion. OpenAI is on track to generate analyzed revenue that tops that number. That's according to sources. That would roughly double its run rate from the end of 2025. I want to bring in Bloomberg's AI reporter, Rachel Metz, who broke this story. Rachel, what specific products are driving this annualized revenue run rate that is such a jump from last year?
So according to what we've been told in our reporting, it's actually kind of a range of things. The company's consumer business is still by far its largest business, and they recently announced that they had passed this 1 billion active weekly user mark, which they've been pushing toward for a long time. So they've got more paying users on the consumer side. They also have a lot more businesses that are using it, and this is driven in some part by Codex, which is its coding assistant.
Okay, well, we can't talk about this as the OpenAI in a vacuum. How does it compare to what the latest is from Anthropic, its chief rival?
I mean, they've been that sort of neck and neck in a way. I hate to say like it's one versus the other because I think that it's like much bigger and broader than that, and there are a lot of companies here in this ecosystem. But I think Anthropic definitely has proved over the last year or so that they're a really handy rival to this company. And they have, especially on the coding front, they in some ways really outpaced OpenAI. But OpenAI is showing us as revenue is going up that customers are also willing to pay for its products as well.
Okay, we're talking top line here. Do we know anything about the bottom line and what expenses are and cost of revenue here and what it's spending?
Ooh, we're still looking into that as far as like specific numbers, but what we do know generally, and I feel like we've talked about this so many times,
we have.
And it's so frustrating, but it's the same thing over and over. Compute is really expensive. It costs a lot. OpenAI has worked very hard to amass a war chest, essentially, of computing power, and it has that at its disposal. And yet the company also will still say that its biggest obstacle is getting enough compute, but that is going to take up a huge chunk of any revenue that it brings in. So other than that, I would say that's probably by far its largest expense.
Bloomberg's Rachel Metz out there on the West Coast. Rachel, thanks for the update. We're going to keep asking you those questions about top and bottom lines at these companies. Appreciate your time. Well, strategists at Citigroup and Bank of America are finding that the CHIPS index is in, quote, bubble land after it rose over 2 standard deviations above its long-term trends in real terms. As risks develop in the AI trade, our next guest argues that early winners aren't necessarily winners forever. And early winner NVIDIA is at the center of it all. Grenadilla Advisory founder and CEO Anna Rathbun joins us now. Anna, you talk about this, quote, duration mismatch between the realities of AI infrastructure and investor expectations. How do you quantify that?
Yeah, we're looking at quarter-to-quarter numbers, and perhaps that's not the right time frame, even though that's what we're used to as equity investors. The hyperscalers and semiconductor companies are telling us, look out to 2027, 28, 29. I mean, they're issuing bonds that go all the way out to 2066. Mm-hmm. I'm not saying that we have to wait until 2026, but we definitely have a mismatch in expectations of when we might actually see return on some of these investments. The revenue expectations that are being promised years out, they have to be able to meet it years out. And that takes a lot of investment today in numbers that we're totally not used to, right? So I think we have to sort of adjust our expectations to be a little bit more longer term focused than we are today. Okay,
but how longer term? I mean, at least when we're talking about memory makers, we still hear about 2030 over and over again. I mean, the visibility quarter to quarter is, I think, tough for a lot of people to comprehend. How much time do we have to wait?
Yeah, and that's the uncertainty, right? And that's why you see the volatility in the markets, and that's basically investors expressing that uncertainty. The answer, I think, is we don't really know, and I'm not entirely sure that the hyperscalers know either. Right now, they are in an existential race. Let's capture that future compute that we get to sell by building data centers and buying NVIDIA chips and perhaps making our own chips. And that is, I think, how the industry is changing. And frankly, we have to wait and see.
A sort of field of dreams. If we build it, they will come?
Maybe.
Okay, maybe. Well, help us envision that future and what it looks like, because there's the conversation too happening where there's no guarantee on this ROI. Do you buy into that, or do you think that there will be an ROI on this?
I think there will be an ROI on it. I mean, and this is the other expectation that we have perhaps misplaced, is the level of compute, right? Overall, we're used to looking at the last 20 years of internet and cloud growth, et cetera. At the AI level, the sophistication of these models and just how much compute that it takes, I'm not entirely sure the market has digested it. And that's why there's so much money going into it. I do believe that we will see the ROI. It's just, as you mentioned before, it's the timing is uncertain. And that's why we have to take a long-term view.
In your view, are we talking about the right names? Are we looking at the right names, at least on the public equity side? We're going to talk to some venture capitalists a little later this hour. You know, they're thinking about it from the perspective of, okay, what are the early companies now we should be investing in? But you focus on public markets. Are we talking about the right names here?
I think those are the names that we have to talk about, because that's where the spend is coming from. That's where the circular financing is. That's where the debt issuance is coming from. And so if you are a public market investors, those names you do have to pay attention to. Now, what we have discovered in the last 2 or 3 years is that sometimes names come up out of nowhere, out of the left field, in terms of being in the front line of AI. So until we see those names, I think we are focusing on the names that we see today. But we do have to think about the risks. You mentioned NVIDIA earlier. It was an early winner. Now everyone is making their own chips. What does that mean for NVIDIA? Now, CoreWeave is actually dependent on NVIDIA, and their debt is actually collateralized by NVIDIA chips. What does that mean for NVIDIA? I mean, I think we have to look at it differently, give it a second look in the same names that we all talk about today.
Yeah, well, we'll find out a couple of weeks what NVIDIA says. August 26th is when they're scheduled to report their most recent quarter. Anna, before we let you go, you mentioned circular financing. Certainly that gets a lot of attention, but increasingly we're hearing about concentration risks and worries that some of these hyperscalers really have two customers, Anthropic and OpenAI. What's your view on concentration risk?
Yeah, concentration risk is something that these companies need to work on. I mean, we heard from Cerebras saying that they actually have a huge concentration risk, right? But they're actually new to the public markets. So I think we're going to have to expect that to reduce the risk. If at least they're not going to be able to tell us when we're going to get the ROI, tell us that they're actually reducing the risk on their business side.
Yeah, well, I guess the question that I have is who would take the place of those large customers at this point?
Well, right, and that's
who else is out there?
Yeah, that's the conundrum of the circular financing, right? Because, you know, it takes so much capital and size in order to build this AI ecosystem that there are a few players, right? And so, I mean, I think we're going to be able to see in about a year or two. I mean, we have the hyperscalers trying to reduce their dependence on the number one supplier. And I think the companies are going to continue to make those innovative changes to their business model. And so this is, unfortunately, is also a wait and see because of the nature of the AI ecosystem and how much money it takes to build it out.
Anna Rathbun of Grenadilla Advisory joining us this morning on Bloomberg Tech. Anna, thanks so much. Do appreciate your time. Well, coming up, Applied Materials beats expectations. Investors, though, well, they're not so impressed. Shares down by about 4.6% right now. We're going to break down the chip equipment giant's outlook next. I'm also watching shares of Broadcom. That owns VMware. Shares of Broadcom down this morning, trading and dragging the S&P 500 lower. It follows a report that VMware security vulnerability being actively exploited across several countries. Broadcom shares off their worst levels, but still down 5.3%. This is Bloomberg Tech. AMD has raised $4.75 billion in its biggest ever U.S. dollar bond sale. It joins a wave of borrowing tied to the AI boom. The chipmaker ramping up spending as demand for computing capacity surges. AMD says the proceeds will be used for general corporate purposes, potentially including debt repayment, with $875 million of bonds due next month. Applied Materials delivered a better than expected forecast. Investors, though, hard to impress. It's the biggest U.S. chip maker of equipment, I should say. It says that customers are pushing it to ramp up production even faster. Bloomberg's Ian King covers all things semiconductors, and he joins us now. Ian, so shares were up about 108% going into this print yesterday. Expectations, fair to say, were pretty high. Looked like a pretty good print across the board. What are investors upset about?
Yeah, whether they're actually upset about anything in particular isn't really clear. I mean, all of the numbers look very clean. But really what we've got is yet another case of a company comes out and says, hey, guess what? Our earnings are going to be hundreds of millions of dollars better than you had expected. And the reaction they get is, yeah, great, we know that. What are you going to do for us next? And so a lot of the conversation on the call was about next year. Okay,
well, let's talk about that, because the question that I think a lot of people have is about how this firm is somewhat of a barometer for the entire industry. Can you talk a little bit about visibility that we got from Applied Materials into what the rest of the year and what next year looks like?
Yeah, no, that's a very good question, and this is one of the reasons why you would concentrate on a company that does something a little bit more esoteric. So what the CEO told us in a conversation, after the numbers hit was, look, I've got 8 quarters of guidance from my customers because it takes so long to make this equipment, to then ship it, to then install it and get it up and running in these factories. We have to plan over the horizon, and guess what? They're giving me even more visibility than they normally would. So he's saying, look, next year things are going to get better. So the call was all about, well, how much better? Tell us exactly how much better. And he's saying, look, a lot better. So I don't really know what more of a conversation that you could have as a management team at this point.
Ian, before we let you go, we have 30 seconds. You've been doing this a long time and covering these types of companies a long time through different cycles. So I'm just curious, contextualize the moment for us. Have you seen anything like this?
Never. The extent that we are, sort of getting in front of ourselves and projecting growth, we've never seen anything like this. We've seen ups and downs before, but never anything to this extent.
Ian King, it's always great to chat with you. Thanks for getting up early. Do appreciate it. That's Ian King out in our San Francisco bureau. Well, Chinese AI firm Z.AI is upgrading its flagship model as it looks to close the gap with U.S. rivals OpenAI and Anthropic. The new GLM 5.3 will focus on stronger coding capabilities and stronger performance gains over its previous model. The company plans to release the new LLM weights within 2 weeks, allowing developers to download and customize it. Stanford's AI index finds a striking divide in attitudes toward AI in China and the U.S. But the question, what's driving that gap? And could China's enthusiasm give its AI industry an edge? Bloomberg's Min Lo explains.
The Stanford University AI Index shows that more than 80% of Chinese are optimistic towards AI compared to less than 40% in the US. And Edelman has a similar survey showing the same trend, that more than 70% of Chinese trusts AI compared to less than 40% in the US. And again, why is there such a huge gulf in attitudes between Chinese and Americans? One reason could be people's experience with technology. In China, over the last 2 decades, it's still in a rapid development phase, and people's experience of tech is one of empowerment and transformation. We're talking about rural residents getting to sell their goods through e-commerce channels, leapfrogging credit cards to become a cashless society, experiencing the convenience of door-to-door delivery and very cheap, efficient logistics, for example. But in the US, that's already a norm, right? People are familiar with big box retail, they have reliable mail, and the experience of the tech explosion has been one of addiction, data privacy violation, over-concentration of power in big tech. So that's one reason. And the other concern is around whether there is enough guardrails that has been put in place. And in China, these tech firms are still under the thumb of the government. They're constantly worried about crackdowns. And when the government pushed this common prosperity campaign, tech firms were rushing to pledge billions of yuan to support that. While in the US, it's a different story where you have a revolving door where tech executives raise funds funds to run political campaigns where billions are being poured into lobbying. So again, that concern around guardrails, and there's just not enough trust that the government is protecting the interests of residents. So why does this matter? When people are more willing to try new technology, that means market adoption rate can be much faster. And while China lags behind in some of the foundational technology like the chips and the hardware, Chinese firms could have an advantage in having that more fertile ground to test new products and to allow much faster adoption of new AI products. Min Lo, Bloomberg News, Hong Kong.
Well, some breaking news crossing the Bloomberg terminal. Luigi Mangione to plead guilty to killing of healthcare CEO. Once again, Luigi Mangione to plead guilty to U.S. charges. This according to Luigi Mangione's lawyer. We'll continue to bring you updates on that story as it continues to break. Well, staying with China's AI boom, DeepSeek is sharply raising prices for its flagship V4 models. Peak hour rates will more than quadruple starting August 16th. This as the startup prepares for a potential IPO and puts greater focus on profitability. Even after the hike, DeepSeek says its models remain significantly cheaper than major rivals. Well, coming up, how close are we really to a world full of humanoid robots? We've got some answers next. This is Bloomberg. The promise of embodied AI, think humanoid robots, drones, autonomous vehicles, seems to be coming into its own and increasingly entering the real world. Bloomberg Tech Europe's Tom McKenzie spoke with Google DeepMind's head of robotics, Carolina Parada, about whether physical AI is finally having its, quote, ChatGPT moment.
I would say not yet, but you can see it. You can see it you can see the light. In my opinion, it depends what you call the ChatGPT moment for robotics. In my opinion, a ChatGPT moment for robotics would be one where everybody can experience what it's like to interact with the robot, and the robot responds to what you want and does what you want in a completely new environment or a completely new setting. So that's what it means to me. I don't think we're there yet, but we're getting there.
What gets us there? What are the technological barriers that need to be overcome to get to that point?
Yeah, I mean, this is precisely what we're invested on. So our goal is to build the intelligence layer that can power any robot and make it really intelligent so that it's intuitive for humans to use, so that it can do a broad range of tasks, so that it can make the robot smart enough to understand an environment, reason about it, and then take action to complete a completely new task that you might have asked it to do. That's what we're going after. I think that there's been significant progress over the last 3-4 years. I mean, before, robots didn't even understand what an object was or what their environment. They were just simply points in space without any meaning. We've actually introduced around 2022 LLMs and VLMs into robots that taught them what to understand natural language. It also taught them how to reason about their environment and then how to take action in a way that was towards a particular semantic task or a particular meaningful task for the robot. That didn't exist before.
Humanoids get a lot of headlines. They get a lot of buzz. Do you think that's distracting? Do you think investors, the media, others, do you think we're kind of overly obsessed with humanoids?
That's a great question. I mean, we believe in a world where there will be many different robot types. I actually think I'm very practical about this. I think that there's going to be a lot of tasks where a different form factor that is not a humanoid is the right thing. However, I do think humanoids are going to become useful and are going to be an important form factor for a few reasons. First, I think the world is made for humans. So if you want to immediately deploy a robot in an environment that is human-centric, then a humanoid is probably going to be an easy one to deploy. Actually, there's an interesting research aspect to this, which is if we want robots to learn from humans and the robot has a human form factor, it's actually easier because it can now translate what the human is doing when he's, say, cooking a recipe into what the robot should do in order to do the same task. So that's a learning perspective that I find interesting. And then the other piece is that my goal is to really show that we can get to AGI in the physical world. What does that mean? It really means that the robot can do anything a human can. So I feel like humanoids are going to enable us to show and really believe that we have gotten to that level. So that is another reason why I like it. But we care about all kinds of robots, and we're interested in bringing intelligence to all robots.
That was Google DeepMind's Carolina Parada speaking with Bloomberg's Tom McKenzie. You can check out the full interview in the latest episode of Bloomberg Tech Europe as Tom looks into whether we are on the cusp of a robot reality. You can find it on YouTube and Bloomberg.com. Well, let's take a look at more tech stories with Bloomberg's Yahaira Anand now. Yahaira, take it away.
Hi, Tim. It's time now for Talking Tech. First up, France's highest court blocked a ban on social media for children under the age of 15, calling the ruling unconstitutional for harming youth's freedom of speech and communication. The ruling shows how global efforts to ban kids from social media are crashing into major legal and technical roadblocks. Plus, Nintendo climbed as much as 7.5% in Tokyo today following the success of its hit game Pokemon Pokopia. The Nintendo Switch game's global sales topped 5 million units since it launched back in March. Shares are on course for their third weekly gain, the longest winning streak since November. And a judge ordered Kalshi to stop offering some wagers in Washington state after regulators said the prediction markets app likely constituted an illegal gambling operation. Kalshi's head of enforcement, Robert Deneau, spoke on Bloomberg Surveillance earlier today.
The exchange model operates differently than a sportsbook model. A sportsbook profits every time somebody walks in and puts up money. If they lose, the sportsbook wins all that money. An exchange model is fundamentally different. What you're doing is pairing users who are setting the price amongst each other in an order book that is open, impartial, and fair, and available nationwide. And operating an exchange that fits that framework requires federal regulation.
Well, coming up, Cornell University's Director of Labor Education Research, Kate Bronfenbrenner, joins us to discuss New York's battle with Amazon over its delivery workers. This is Bloomberg Tech. I'm also watching shares of Micron and SanDisk as we speak right now. Shares of Micron are higher. Pierre Ferragu over at New Street Research upgrading the stock to buy from neutral. He writes, even with strong share price appreciation, the company is attractively valued based on a metric of price to cost of goods sold. Micron shares were higher earlier, but still up 1.3%. SanDisk also surging today, up close to 6%, but take surging with a grain of salt. I mean, shares of SanDisk this year, they're up close to 600%, up 5.8% right now. JP Morgan assigned an overweight rating following the firm's investor day. Remember, shares surged 14% yesterday. We're talking Amazon, and we are talking labor, specifically when it comes to how those packages get to people in New York City. That's coming next on Bloomberg Tech. Welcome back to Bloomberg Tech. Let's take a look at the NASDAQ this week. We did see the S&P 500 hit a new all-time high this week. The NASDAQ, though, even though it's up over the last 5 days, about 0.8%, underperforming at least the recent high of the S&P 500. The decline in retail sales that we got this morning means that bets are increasing that the Fed is going to hold rates in September, meaning a lot can happen between now and the next policy meeting. But at least for now, there's less of a risk that the Fed actually raises rates at its September meeting. We'll wait to hear what Chair Warsh says, of course, at Jackson Hole a little later this month. Well, a new bill backed by New York City Mayor Zohran Mamdani threatens Amazon's cheap delivery model. If the Delivery Protection Act passes, the e-commerce giant may pull up stakes and make all New York City deliveries from hubs outside city limits. But Bloomberg's Spencer Soper writes in today's Tech In-Depth newsletter, proponents of the bill say Amazon can't abandon the city because that would lengthen delivery times, which it is perpetually trying to shorten. We're now joined by Cornell University's Director of Labor Education and Research and Senior Lecturer, Kate Bronfenbrenner, to help us make sense of it all. Kate, I just want to start with the way that traditionally delivery companies have involved humans in that last mile. What have they done in terms of a structure to, employ them or not directly employ them?
So the delivery service model is one where the companies try to distance themselves as much as possible from the workers, and the responsibility for the workers and the liability for the actions of the delivery drivers and the vans it allows them to exploit the workers and deny responsibility for accidents, traffic problems, worker health and safety issues, and to pay workers lower wages and lower benefits than they otherwise would.
This is distinctive from, let's say, UPS, for example, which is known for having a strong union and directly employing those UPS drivers and UPS delivery workers that you see delivering packages, correct?
Exactly. These companies are trying to say they're not joint employers, they're not responsible, they can't be unionized. Very different from UPS, and much more dangerous working conditions and much less liability for the actions of the delivery service providers.
So let's talk about this Delivery Protection Act, because the folks who say, if this passes and Amazon has to directly employ delivery workers who deliver packages within the city, then Amazon's going to just move town over to New Jersey or something and employ workers there or get deliveries made from there, then they won't have to adhere to this. Is that a realistic concern that the city should have?
Well, first of all, that is a decision, that's a choice that Amazon would make. Obviously, Amazon is making huge profits. One of the most profitable companies in the history of the world. They definitely can afford to do better by their workers. And their whole system is designed to get things to people faster and faster and faster, to same-day delivery. It is not in their interest to move outside the city, and the amount of extra money it's going to cost them is just a tiny fraction of the amount of profits, billions and billions of dollars of profits they make each year.
Do you think, though, that the Delivery Protection Act is the right approach to this?
Well, at a time where we really can rely on the federal government less and less to protect workers and to protect consumers, many organizations are turning to states and cities in order to, provide regulation that our federal government is no longer providing. There has been a dramatic increase in the number of accidents. There are 18 DSPs in the New York City area, and then 78% of the communities in New York City, crashes with injuries have risen. And these are serious accidents. Worker safety has gone down, worker pay and benefits have gone down. So, the city of New York is committed to improving the status of the working class in the city. Mondani has made that very clear, and this is a step in that direction. But New York is not alone. Cities and states across the country are realizing that they have to take over what the federal government did in the past.
I'm coming to you from New York, and the scale here of the package delivery is actually just completely unbelievable. I mean, Spencer, our colleague, Spencer Soper, in his newsletter writes about 2.5 million packages delivered every single day in New York City. So about a third of the people who live here are getting a package each day. I mean, you can see these trucks that are outside of our office here, and they're just loaded. The entire tractor trailer is loaded with packages to be delivered, and that's just in Midtown. I'm wondering about companies that are not Amazon here, Kate. If obviously Amazon's the 800-pound gorilla in the room, but a lot of things come from other companies. Would this affect other companies too?
Well, right now, Amazon kind of sets the standard because it's so big. So what it does, everybody else has to do. So if Amazon has to treat its workers better, it will make it easier for the other companies to treat their workers better and be competitive. Amazon has to, like all the companies now, are going to have to get licensed by the Consumer and Worker Protection Bureau, which is going to track labor and employment violations, and consumer violations. So if companies do right and follow the law, they will be able to get licensed regularly. Amazon will not be able to be an outlaw just ignoring every regulation as it has in the past.
Kate, can you explain why, like I understand the idea of these delivery service partners, these DSPs, why maybe the wages wouldn't be as high and the benefits wouldn't be as good as if they were, as opposed to working directly for Amazon. But can you explain why conditions will be safer for them and why you think there would be fewer accidents if they were employed directly by a big company?
Because right now, the big companies are not liable if there's an accident. So even though we all know that those drivers work for Amazon, they're wearing Amazon uniforms, their routes are set by Amazon, their hiring is overseen by Amazon, their hours are seen by Amazon, but Amazon right now does not have to take responsibility if there's an accident, or if their drivers are being pressured on productivity so that they have to drive so fast that they are, breaking the laws. But if Amazon is then responsible and can't get a license renewed to be a delivery provider, then it's going to make conditions safer, consumers more protected, and enforce the laws of the city when it comes to traffic and accidents.
Kate Bronfenbrenner, appreciate your time this afternoon, or this morning, I should say, joining us over at Cornell University. Kate, appreciate it. Well, I'm watching shares of Reddit. They're surging this morning, up 14%. This after the company we learned yesterday is set to join the S&P 500. Look at that. It's going to replace Avalon Bay Communities. That's being acquired by Equity Residential. Now, this is a big deal because now passive investment funds have to buy shares of Reddit. So that's why inclusion these days in an increasingly passive world is just becoming more and more important for companies. Shares of Reddit down by about 20% this year, up today by just about 14%. Coming up, Sean Johnson joins us, general partner over at 224 Ventures. He's going to talk to us about launching the new firm with AI heavyweights. This includes Jan LeCun and Oriol Vinyals. This is Bloomberg Tech. Drive Capital is seeing a massive payoff from its early bets on AI. Josh Kushner's 2022 venture fund has grown more than sevenfold to $3.7 billion. It's been fueled by investments in companies including OpenAI, SpaceX, and Anduril. Bloomberg's Natasha Mascarenas joins us now for more. I guess, does this answer some question about where money comes from to buy the Lakers for $12 billion? I don't know.
We'll see. We'll see. We know that Thrive is going to be putting some money into it. But yeah, the news that we broke last night gives us an answer on why Thrive's approach for concentration in the top positions in its portfolio is definitely making a difference. Like you said, the 2022 fund is up about 7x from where LPs put in it just a few years ago. And I mean, VC firms take between
Yeah, Natasha, it's a great story. Unfortunately, we're having some problems with your connection. It's a great story on the Bloomberg terminal and at Bloomberg.com. Congratulations on the scoop. That's Natasha Mascarenas. Check it out on the Bloomberg terminal and at Bloomberg.com. Well, sticking with AI and venture capital, 224 Ventures is a new AI-native venture firm launched by former AIX Ventures co-founder Sean Johnson, ex-Google DeepMind researcher Oriol Vinyals, and AI pioneer Jan LeCun. The trio plans to make seed stage bets and launches with more than $100 million in assets under management. 224 Ventures partner Sean Johnson joins us now. Sean, good to have you. Congratulations on this news. I'm curious about what you see as sort of the white space out there in Silicon Valley and really the world when it comes to these AI bets. What are you thinking about?
Tim, thank you so much for having me. White space is harder and harder to find, given, I think, since 2022, we've been operating in a fairly noisy market, many consensus bets years over year. So what we're thinking about is what stories do founders come with that we actually believe are non-consensus, that are not obvious, that we walk away thinking, maybe that's not right. But then after thinking about it, getting to know the founder more, we recognize that there are a series of things that could be proven to be true that would change the world and make that company, in fact, a market leader.
So much of the oxygen, at least in what we talk about in the massive valuations for two big firms, OpenAI and Anthropic, of course, it's sucked up by that. And yet yesterday, our Bloomberg News team, it was Wednesday night, had this just incredible scoop about Anthropic possibly making a $6 billion acquisition. And it was funny because I think a lot of people who are outside the industry don't even necessarily know what Descartes AI does. But it was a good example of sort of, the massive market, even at a level with a company that is worth like $1 trillion in the private market right now. I'm curious what you see as the opportunities that are out there. Like what exists in terms of tech, in your view, that 5-10 years will become the next OpenAI or Anthropic?
Yeah, of course. There's a massive opportunity in the future of work. We're just getting started there. How do we think about, to date, we've been thinking a lot about chatbots. How do we think about AI actually doing jobs themselves and having humans there, laborers, workers to say, yes, that's right, no, that's incorrect. This is the very beginning of that. Robotics has both consumer and business applications, and business is wonderfully fragmented. There's a ton of white space there. And then infrastructure. When you think about what agents are going to need to be productive across applications, that infrastructure is just starting to be built out.
I'm curious from your view, are we having the right conversation when we talk about this idea of a zero-sum game when it comes to productivity? Like, you know, some people will become more productive, others will be completely replaced. From your perch as a venture capitalist who looks into this, is that the right conversation to be having?
We believe it's not a zero-sum game. As intelligence proliferates through these applications, it's just the nature of our labor is going to change. There are going to be many more jobs. They're just going to be different. They're going to be higher leverage. Frankly, they're going to be more engaging. And so we're excited about the future where AI is taking away the more mundane jobs humans are doing today and sort of levels us all up.
So you're not concerned about like a wipeout of white-collar jobs that Dario Amodei of Anthropic has talked about in the past?
There's certainly going to be, I would say, a shift in jobs. There are going to be a movement from the more mundane to the less mundane, the more engaged. And I think that's what Dario's talking about. We're going to have to reskill. We're going to have to think about the implications for a large number of workers. But again, there are going to be additional jobs too. And the big question is, how do we navigate the transition?
Okay, I've got a bunch of questions about the fundraising process and also about your partners at the firm. I want to start with fundraising. You're launching with $100 million. How difficult was it to raise that, or how easy was it to raise that? I know it's never easy to raise money, but I think it seems like a lot of people want to invest in early stage companies out in Silicon Valley right now.
We raised that capital across just 2 months. So
easy.
It was fairly straightforward, yes.
What's the future capital raise schedule looking like?
Well, we think the market's barbelled. You see companies coming out and raising hundreds of millions, billions to start. You also have companies that are raising just a few million to start. And we have a strategy that allows us to invest in both. And so we will, on the more frontier side, we will continuously raise, doing SPVs and co-invest with our LPs. And then we have an open fund too at the early stage that allows us to invest in founders just getting started that are arguably more capital efficient.
Where are you looking right now geographically?
Predominantly Silicon Valley. New York, Toronto, Paris, London, Tel Aviv are all very interesting hotspots for AI.
Is there no question that San Francisco is the leader right now?
There is no question.
What about versus China and the tech that we see coming out of China?
Yeah, it's arguably why we continue to see such massive raises, so much capital come into the ecosystem. There are many geopolitical questions and issues I think that we're grappling with and trying to understand, and everyone wants to win. And so I think we have to be very mindful about enabling researchers from all over the world to come to the United States, to push the frontier, to keep the United States at the bleeding edge is a top priority.
Sean, you're launching this with a couple other huge names, ex-Google DeepMind researcher Oriol Vignals, Yann LeCun, AI pioneer. People know Yann's work in the space. What do they bring to the table when thinking about where to invest?
Yeah, at the early stage, number one is community and access. Who do we know? Who can we interact with at day zero that's just starting to formulate an idea? And Jan and Oriol are embedded in the ecosystem. Jan, of course, executive chairman at Advanced Machine Intelligence, professor at NYU. Oriol just co-founded Discovery Loop and former co-lead of Gemini. So they're wonderfully connected. Dario, you brought up at Anthropic, spent time at DeepMind. The Perplexity team came out of NYU. And so you're looking for wonderfully connected investors, partners, and Jan and Oriol are just that.
Sean Johnson, general partner at 22 Ventures, joining us out there in Silicon Valley. Sean, congrats, and thanks so much for joining us on Bloomberg Tech. I want to get back to some more breaking news. Luigi Mangione has now formally pleaded guilty to U.S. federal charges. His sentencing date now set for December 18th. This news comes as a hearing is underway today with U.S. District Judge Margaret Garnett, which was set after federal prosecutors and defense lawyers jointly requested one. The guilty plea is the first admission of wrongdoing by Luigi Mangione. Coming up, podcaster Alex Cooper's beverage business is shutting down, highlighting the challenges that online creators face when expanding beyond content creation. We've got that story next. This is Bloomberg Tech. Call Her Daddy host Alex Cooper's beverage business is shutting down. The drinks brand was launched by her company Unwell in partnership with Nestle last year. It will cease production in the fall, according to sources. It comes on the heels of Unwell raising money at a $500 million valuation to support some of Cooper's other business lines beyond podcasting. Let's get more with Bloomberg's Ashley Carmen. She joins us here in New York. I'm a little out of the loop with the podcasting and the beverage side of things, but this was launched to a lot of fanfare, and she had a good reason to launch it. She said, you know, you didn't see the energy drink market catering at all to women. It was all aimed at men. What happened here?
Yeah, she had a solid pitch. You know, Alex's thing is she's talking to Gen Z women. She wanted to design drinks that were for Gen Z women. But the reality is the beverage business is wildly competitive. I mean, Logan Paul, as an example, he has an energy drink. Emma Chamberlain, a YouTuber, sells a coffee line. These are just two off the top of my head of people who are trying to break into that business too. And it's hard. You have to constantly remind people to keep buying your beverage. And if they're not feeling it, then that's what happens. Okay,
this is a part of Alex Cooper's story and a part of Unwell, but the bigger context here is what happened and what is happening behind the scenes at the company right now. You've done a ton of reporting on this.
Yes. So, I mean, there's been a lot going on this year. First of all, just this week, we learned that they raised money at a $500 million valuation for her company Unwell, which is her broader media company that she operates with her husband and business partner, Matt Kaplan. That came from Patrick Whitesell, a major Hollywood agent. Prior to that, I had reported earlier this year kind of what's been going on behind the scenes. So there's just been a ton of staff turnover, including executives. We did some reporting around how Matt has berated staff in the office. And really just this idea of trying to build a podcast network has kind of fallen flat. There really hasn't been any shows of hers beyond Call Her Daddy, which is what made her famous, that have broken through into the mainstream in a major way.
And yet that $500 million funding round shows that there is confidence behind her and the brand.
Yeah, totally. I mean, she is a talent, of course. I don't think anyone's denying that. It's just a question of, okay, where does your business go from here beyond just you?
So who else has been able to, and we only have about 30 seconds left, but what are examples of podcasters who've been able to take a brand that has a huge and loyal following and build it just beyond that podcast?
It's been really difficult. I mean, you see people like Joe Rogan, for example, who he has not hired a ton of people. He's not built a media company.
Seems like he just likes podcasting.
Yeah, he does his podcast. He makes plenty of money doing that. But then he's like opened a comedy club. And seemingly that's doing really well. It just gets a little tricky when you start expanding your empire to bring on tons of employees and do a lot more.
Bloomberg's Ashley Carmen. Her reporting is fantastic, and it's on the Bloomberg terminal and at Bloomberg.com. That is going to do it for this edition of Bloomberg Tech. Check out our podcast. You can find it on the terminal as well as online at Apple, Spotify, and iHeart. Have a great weekend, everyone. This is Bloomberg.